So until last video, we talked about how to estimate the discount rate. And from this video on, we are going to focus on the cash flow part of our valuation. The first thing we're going to touch is the dividend discount model, the very basic, fundamental form, the primitive form. Um, Two channels of value. Okay, we are living in a very simple world for finance guys. We have only two things to consider. One is discount rate, the other is cash flow. Isn't there growth potential? You may question, but that growth potential is about the cash flow. So the valuation formula looks like this. Whatever value of your asset as of today, okay, that's nothing but expected future cash flow discounted at relevant cost of capital over infinite time horizon. And if you assume a certain slow growth rate of your cash flow, and then the formula becomes what we call Gordon growth model. Cash flow next year divided by R minus growth rate of cash flow, assuming that the growth rate is less than the discount rate. So we mastered this discount rate part. Now we are moving on to the cash flow part and the growth included, right? So that's our roadmap right now. Now we will learn how to compute cash flows from now on, and cash flows in the past, well, cash flows in the future. Those two we have to distinguish, and then we have to study. Well, cash flows in the past. Well, why do we pay attention to cash flows in the past? To understand how the company or the management performed in the past. It gives us some good information about the quality of the managers and then their pattern of decision making. You may extrapolate the growth trajectory into the future up to a certain degree. Okay, if the company was doing good in the past, more likely than not, they will perform good, and vice versa. But that's not all, because the business environment, the business cycle changes, and the management team changes, and the people also change. So cash flows in the future is something we have to consider in addition. It is pretty much the same as how you compute the cash flow in the past, but it is projected based on a lot of assumptions about growth, reinvestment, and profitability or efficiency, etc. in the future. Okay? Now, cash flow to the investors, we have to think about the cash flows that we can anticipate to receive. Okay? Well, what are the major claimants of the cash flows of the corporations? Well, we have three different claimants of cash flows. The first, perhaps the scariest claimant of the cash flow is the government, because you have to pay tax, right? It's about the social contract, right? They protect you. Okay, the government charges tax upon your business because they provide the military protection against North Korea. Otherwise, your business will be extracted by Kim Jong-un or Putin or whatever, the dictator, okay? South Korean government is protecting you. So you have to pay the expenses, right? And also they provide, the police services, right? So that you will be doing business in safe environment, police forces. So that's why you have to pay taxes anyway. So the government is the first claimant of your cash flow, okay? Don't try to evade this thing, okay? You'll be in a whole lot of trouble, okay? So the first claimant is the government, okay? We often forget it, but we have to, okay? Like oxygen, we just forget. But this is a very precious one. Next claimant is a debt investors, right? By law, you have to pay interest expenses to the bankers that you lent the money to you, okay? If you don't, if you fail to pay the interest, well, we call you're defaulted, right? And you're bankrupt. So you have to think about the debt holders, right? Debt investors, your cash claimant. And then the last one is the equity holders, which we call them residual claimant. Whatever is left over, it's all yours, equity holders, right? The shareholders. You are taking the risk, okay, as the owner of the company, if the company goes bankrupt, you are screwed as an equity holder, right? So you are the high risk taking and expecting high return out of it. In contrast to equity holders, debt holders, you are protected by law, right? So that it's a safer investment, low risk, low return, right? And so that's those three claimants of the cash flow. Please remember: government, debt holders, and equity holders. Now, debt holders and equity holders, we call them firm investors. Government, we don't call them investors, right? They're just government, okay? And cash flow is the one that comes to the investors by doing day-to-day business after paying tax and after reinvesting for business expansion. So, well, here we have to, be careful, okay? What is the cash flow, okay, that we can safely assume it to be coming to the equity holders as a shareholder, okay, as a claimant. So so why don't we just work with the net income, okay? You may question, you learned about the accounting basics and the financial statement, so you can think about net income, okay? Why don't we think of it as a cash flow to the equity holders? Good question, but there are something we have to consider together, okay? If the cash flow is to the equity holders only, it should be after repaying debt to the creditors or debt investors and borrowing from them. So, measuring cash flow, how does it work? We largely have two different families of DCF. One is equity cash flow based valuation. The other is the firm cash flow based valuation. Okay, cash flows can be measured for just equity investors or both equity holders and debt holders. So if we choose the first one, the red box one, okay, we still have two different ways of measuring the cash flow to the equity holders. But commonly in this red box, we're going to use the cost of equity, okay, RE, cost of equity, as the relevant discount rate, okay. How about the green box over here? For this part, we're going to use the WACC, weighted average cost of capital, as the discount rate, okay. And then what's the matching cash flow that we have to use? Well, there we have two choices. The first one is dividend. The other is free cash flow to equity. What about the cash flow we use in the green box? That is, well, free cash flow to firm. So the first red box first, okay? The dividend discount model is the one we're going to talk about in this video. There, the cash flow, the understanding is that the cash flow going into the equity holders is primitive form, is dividend, okay? Like thousands of years, right? Ever since the corporations were formed, and then the entrepreneurship was formed, like in let's say in Columbus era, or like in the Middle Ages or something, right? Your entrepreneurship, your business, right? Well, you must have had some partnerships and equity holders. They were raising capital together, and then they were taking risk together, and then after sending their ships to India or Malaysia area, okay, and then bring back those take those what is it, the peppers, and then all this kind of cinnamons and all kinds of exotic goods they just imported, and then sell it in the European market and make money, make profits. Then what do? Pay dividend to your equity investors, and that was it. So the dividend was a very, very primitive form of cash flow available to going to the pocket of equity holders, shareholders. Okay, so here, very simple. Let's just focus on dividend and treat it as the only cash flow. Let's discount it at the cost of equity. And then these days, or in 20th century, we have another more advanced form of rewarding the shareholders, equity holders, which is called the repurchases, which is meaning the same thing as dividend because the company is spending cash for the benefit of the existing shareholders. So either you pay cash directly to the shareholders in the form of dividend, or indirectly, okay, just repurchasing the stock and then burn it and reduce the number of shares outstanding. Okay, they're the same dividend anyway. So that's how we measure the dividend and then discount it at the cost of equity. The other form is called free cash flow to equity. I just throw out the formula first because this is Korean format of learning. Just throw out the format and then I'm going to explain later. Wait for that. Just to hold on to that curiosity. What the heck is going on this formula, right? You start with net income and subtract capital expenditure and add back depreciation because this is minus minus plus, right? And then subtract the change in non-cash working capital, and then subtract your principal repaid, and then add your debt, new issuance of debt, new borrowing. Minus minus is plus, right? What is going on? Keep that curiosity in your brain, okay, mind. The next one is a free cash flow to firm, okay? That is, you start with operating income and then subtract marginal tax, okay, based on it, and then subtract capital expenditure and add back depreciation, and change in non-cash for cash working capital is subtracted one more time, okay? So something similar is going on, something different is there. What's going on? Keep that curiosity in your mind, okay? We'll touch on that issue later. Now, roadmap, well, dividend discount model is the thing we're going to talk about here. Dividend, well, this is the most classical form of cash flow to equity holders. So here I just list up the our income statement of any hypothetical income statement. Well, the first item, line item over there, top line is the revenues, and then there we subtract the cost of goods sold, and then subtract SG&A, sales, general, and administrative cost, and that will give us the operating income or EBIT, okay, earnings before interest and tax. Then what do? We subtract interest expense, okay? Why subtract interest expense after calculating the operating income? Because paying interest expense is not really about your day-to-day business. Operating income, EBIT, okay, the purpose of measuring this thing is to gauge the strength of your day-to-day business, okay? In your main business, how much money do you make? That's EBIT. But interest expense has almost nothing to do with your day-to-day business. For example, Apple, okay, how well are they doing in their iPhone selling business? Well, that's EBIT, but how much interest do they pay for their borrowed money? Okay, well, that rarely affects the iPhone sales anyway. Of course, some of you may say, if the Apple is more likely to go bankrupt, you would not buy iPhone for whatever long-term reason, right? But except for that kind of rare cases, usually interest expense is about the financing side of the business, not the operating side of it. Okay, so financing side, get it out of the operating side. Let's just focus on the operating side. That's what's going on over here. We will come back to this issue later on in the free cash flow to equity and free cash flow to firm measure. Anyway, so we subtract interest expense at this stage, and then subtract the non-operating expense and add non-operating income. For example, FX, foreign exchange gains and losses, right? Those are usually in non-operating side. What is that? For example, Samsung Electronics, right? Samsung Electronics, their major business, day-to-day business is about DRAM manufacturing, chip making and selling it, okay? Well, foreign exchange, Korean won versus US dollar fluctuates a lot, right? Nowadays, $1 is as much as 14 186 Korean won or something. It used to be like 1500 or something. And sometime, a long time ago, it used to be like 800 or something. So the foreign exchange rate fluctuates, and that affects your profitability as you export more goods and also import some goods. So the foreign exchange related fluctuation of your profitability, well, that is not really about your operating side, but that's something out of your control. It's about the macroeconomy, not the Samsung's decision making, out of the Lee control. So as long as that is out of the control, let's take it, okay, recognize it as non-operating income or expenses. Um, that's the idea. Then we'll come down to the profit before tax. And once you subtract this profit before tax, starting from profit before tax, you subtract tax amount, and then you'll finally get into net income. That is our income statement structure. From then on, what do you have to do? Our final destination in this video is about the dividend, okay? Out of this net income, what can you do? You pay dividend to say thank you to your shareholder. Thank you for your investment. Here is our treatment, okay, reward to you, okay? So that's dividend. And you don't pay a whole lot of net income back to your shareholders, but you reinvest, plow back into your business, right? So there is a retention going on. Only a part of it usually goes to the dividend, and the remaining part gets back to, is invested back into your business. Why? Because you want to compete in the product market and compete and grow, okay, your business. Otherwise, if you pay everything back to your shareholders, then how could you grow your company? Okay, of course, you can still grow your company with borrowed money and things like that. But typically, a major part of it, okay, it is retained and reinvested. So the cash flow measure in dividend discount model is this guy, okay, dividend. Now, dividend discount model, well, the example that I show you here is a Korean company, a stable company called KT&G. KT&G, for example, here the idea is that to be able to use dividend as cash flow to the equity holders, well, you need to have stable business to generate dividend this over the significant time horizon. If your company has to grow fast, if your company is in the tech sector like the companies in the Silicon Valley, you cannot afford to pay dividend. Okay, the fact that we are using dividend discount model already assumes that your company is in the stable stage or reasonably well paying the dividend. Okay, out of the net income, significant part goes into the dividend. If so usually the companies in the stable stage, food and beverage, or the companies that have a long history, we tend to use dividend discount model for this kind of companies, not for tech sector companies. So the example that I picked up for this discussion is KT&G. Okay, what is KT&G? Well, it's a cigarette company, okay, and ginseng company. It's a kind of interesting history because most of the countries in the world, right, take this cigarette companies or things like that as government owned companies, right? Right? Because you go to military and then you realize everybody smokes in military. Of course, right now in Korea, smoking is out of fashion. You don't try to smoke. But for other countries, right? You go outside and then you will realize this smoking and then cigarette makes a good business for government. so that they could generate some revenues instead of just extracting tax from the general public. Why don't we sell this kind of tobaccos and to the general public, and then increase the revenue for the government? Okay, so that's why KT&G started as a government-owned company. Okay, 담배인삼공사. It was a public company, and then their culture is still well known to be more like a public servant. Okay, bureaucracy going on, and then also in Korea, thousands of years, we were well known for ginseng. Ginseng is a Eastern medicine, and it's a root of a vegetable kind of growing in the mountain. Sansang is a mountain. It's a very, very expensive one, and then you just cultivated it, and so that we just grow it as a farm. Okay, so that's how it took off 1,000 years ago in Korea dynasty, and then Korea dynasty was doing good business with ginseng selling to the China. And one long time ago in Qin dynasty, Jin Huang, Qin dynasty. And by the way, the Qin, okay, China, China, the word came from Qin dynasty. And then the first emperor of China, okay, wanted to live forever. So he sent many people to Korean Peninsula eastward, looking for this, mysterious, drug for longevity. We believe that is ginseng kind of things, red ginseng or whatever. So that tells us a lot about how this business was profitable ever since, long history. Okay, so we will come back to this KT&G in the next video. So wait for that.